Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today during our third segment of the show. If you missed the first couple segments, we've been talking about the fiscal cliff, and we just introduced a topic called bear markets, a necessary evil that is something that Larry Swedroe, I don't know if he coined it, but Larry Swedroe wrote an article back in 2008 entitled that, and I think it's a great phrase that we're going to use. So anyway, if you missed the other shows, head on over to our website, dlblain.com, and you can catch up there. So we're talking about this necessary evil, bear markets, and we started with a discussion of, risk and reward. And as you go beyond the Treasury bill, which is short-term debt instrument issued by the U.S. Treasury, which are still considered the risk-free asset, as you move away from that, you accept some sort of risk. Burying the money in your backyard, you're accepting the risk of, theft, although not a great risk, but theft, but more importantly, inflation, that your money falls below the level of inflation. If you move beyond the Treasury bill and move into Treasury notes and Treasury bonds, especially the 30-year bond, you're accepting what's called duration risk, meaning that the interest rates could change in that time frame. So if you buy a 30-year bond today that's paying 3.5%, and 15 years from now, rates are 7%, inflation has gone up and rates are 7%, you have lost a lot of your purchasing power by owning that 30-year bond. You were guaranteed that return and you're getting that return, but you accepted duration risk. So you have inflation risk, duration risk. If you venture beyond the U.S. government, and I know there's some debate as to whether the U.S., there's credit risk there, and I think there may be some, but the reality is in the world, and the U.S. is still dominant global position, the U.S. dollar and the ability to print money. It's compared to everything else, it's a lot better. Anyway, so as you move beyond the U.S. government and maybe some other governments and some high-quality corporate bonds, you have what's called credit risk. So, for example, if you went to your neighbor and your neighbor wanted to borrow money from you, or you could get, or the U.S. government wanted to borrow money from you, there's a credit risk. Which one's going to be more likely to pay the money back? And I know I'm going to get some comments on that, but in general, the U.S. government would be, a safer risk than somebody that walking off the street. Anyway, so you accept credit risk in companies, loaning your money to a company, loaning your money to the Venezuelan government, a huge credit risk. And so it's expected that you would earn more return for accepting those risks, either inflation risk, duration risk, or credit risk. As we move into other types of investment, we've been talking about bonds and their expected return. As we move into other types of markets, stock market, commodity market, real estate market, things like that, you introduce firm risk. You're not guaranteed a rate of return. You own equity in the company, and so there is no guaranteed or so stated rate of interest like there is a bond. And so there's increased risk in the credit structure of a company. If a company goes bankrupt, as long as the government doesn't intervene and wipe out the bondholders are supposed to receive the assets of the company before the stockholders. So there's more risk being a stockholder than a bondholder. And so the expected return of investing in the stock market or other risky assets, by definition, has to be higher than a sure asset. If there was no risk involved, then the returns would come down to the default no risk level. And so my point in talking about this, back to the topic that Larry Swedroe coined, bear markets a necessary evil, is the risk involved in investing. It has to be there to earn a larger rate of return. And so all these investments out there that, the annuities and the guarantees and everything like that, by definition, they are reducing the rate of return because there's not as much risk. So the expected return is not as great. And remember, I'm saying expected return. Just because you invest in something that has risk does not mean you're going to earn that return. but by definition, it has to have a greater expected return. We've got a couple minutes left. Obviously, I'm not going to finish this topic today, but I do want to talk about the concept of necessary evil and why bear markets are necessary part of investing. They help raise that risk. I mean, that's what people think about when they're investing. If you could earn 8, 9, 10% a year, year after year investing in the stock market and there was no risk, well, everybody would do it and the returns would drive down. It's that fear of the bear market, it's that fear of the investment that you own is going to go out of business that makes it risky and makes the reward available above the treasury bond. So I think it was Alexander Hamilton was talking about the military of a country. He said that that it is a necessary evil to have an army standing ready to resist a power which they suppose may be exerted to the prejudice of their rights. And that's why people tolerate a standing army. It's a necessary evil. Taxes could be considered a necessary evil. Now, not the level of taxation that we have today, you know, sales tax, property tax, income tax, estate tax, I mean, taxes everywhere. But some form of taxation in a modern society is sort of a necessary evil, you know, to provide for common defense and, you know, police protection, things like that. It's what people would consider a necessary evil. It's something unpleasant or undesirable that you have to endure to enjoy a positive outcome. So, you know, you've got to pay taxes so that you have police protection to have a relatively safe neighborhood. And so investors should also view bear markets as a necessary evil. It's that unpleasant or undesirable aspect of investing that you have to endure in order to enjoy the benefits of it. That so many people out there are trying to avoid the unpleasantness or uncertainty of investing, and by doing so, by definition, is they're reducing the expected return of what they're doing. All right, well, we're coming to the end of the show today, and this is a great topic that I'm going to get into some more next week as to why you have to have bear markets in investing. And people ask it all the time. You know, they say, well, I want a safe return. You know, I want a safe, high return. It's just not possible that you're getting paid to endure some of the anxiety and the possibility that your account values go down. Frankly, that's what you're getting paid for. We'll delve into this a lot more during next week's show. I hope that everyone has a happy holidays out there and a Merry Christmas and a Happy New Year. So for All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.